If you're 25 and invest $200 a month, you could retire with over $1 million. If you wait until 35, you'll need almost double. The difference isn't income, it's time. So how much should you be saving right now, based on your age? Welcome to Smart Money Insights Lab, where we break down personal finance and investing into simple, practical strategies. No hype, no complicated jargon. Let's get into it. Before we talk about age, you need to understand one rule. Wealth has little to do with your income. It has everything to do with your savings rate. You can earn $50,000 a year and become wealthy. You can earn $500,000 a year and stay broke. Wealth is invisible. It's the gap between your income and your ego. The higher your savings rate, 20%, 30%, even 50%, the faster you build assets that generate passive income. And remember this, money represents your life energy. Every dollar saved is time you reclaim in the future. Your 20s are the most powerful financial decade of your life. Not because you earn the most, but because you have time. Compound interest needs one thing: time. This is why long-term investors who start early, like Warren Buffett, build massive wealth. Not through luck, through longevity. Even investing $50 to $100 a month in a total stock market index fund can grow significantly over 20 to 30 years. Key strategies in your 20s. Focus on a high savings rate. Start dollar cost averaging, DCA, every month. Invest in broad index funds like S&P 500 funds. Avoid lifestyle inflation. You don't need complicated strategies, you need consistency. Your 30s are when lifestyle inflation hits hard. Bigger house, better car, more expenses. This is where most people fall into the rat race. Here's what matters in your 30s. First, understand assets versus liabilities. An asset puts money in your pocket. A liability takes money out. Many people buy liabilities thinking they are assets. Second, build an emergency fund. You should have 3 to 6 months of expenses in cash. This protects your investments during market crashes. Third, stay humble. Spending money to look rich is the fastest way to stay broke. If you raise your savings rate in your 30s, your net worth growth can accelerate dramatically. By your 40s, money becomes more than numbers. You need to ask deeper questions. Is your spending aligned with your values? Is your job worth the life energy you're giving it? Calculate your real hourly wage. Subtract commuting time, stress, work clothes, decompression time. You may discover you're earning less, in real terms, than you thought. This is also the decade to maximize retirement investing. Increase contributions to retirement accounts. Focus on dividend growth investing. Strengthen your asset allocation. Your goal now is acceleration. Now the focus shifts from growth to preservation. You're aiming for what's called the crossover point. That's when your passive income exceeds your monthly expenses. At this point, financial independence becomes real. A common guideline is the 4% rule. If you have 25 times your annual expenses invested, you can potentially withdraw 4% per year sustainably. Example, if you need $40,000 per year to live, you'd aim for $1 million invested. Also in this stage, rebalance toward bonds and stocks. Keep 2 to 4 years of expenses in liquid assets. Protect against market volatility. This is about finishing strong. Here's the real answer. It depends on your enough point. How much is enough for you? Not society, not Instagram, not comparison culture, just you. Once your income covers your necessities, your comforts, a few luxuries, without stress, you've defined your enough. Every dollar you earn gives you a choice. Spend it on liabilities, or invest it into assets that create wealth and financial freedom. Wealth isn't about earning more, it's about keeping more. It's about discipline, consistency, and letting compound interest do the heavy lifting. If you found this helpful, like and subscribe to Smart Money Insights Lab, where we break down personal finance, investing strategies, and financial freedom in simple, practical terms. Because real wealth, it's built slowly, but it lasts forever.